Welcome to Volatility Trading Strategies. So at this point, several years now since the launch of the original Volatility ETPs, this segment of the market is now becoming more mature. I'm pleased to see investors finally warming up to the idea of treating volatility as an investable asset class of its own, and adding a little bit of volatility exposure to their portfolios. Years ago, when I started trying to make that case, it was a little more difficult to get people comfortable with it because it was so new. VIX futures, roll yield, contango, these were not commonplace concepts. But fortunately these days the market is more developed, and most people are not only open to volatility investing, but actually excited about it. And with any developed market, that means there's going to be different ways to trade it. Here at VTS, we have 3 different strategies that target the full spectrum of risk tolerance. But that does beg the question, how do investors choose the one that best suits them? Let me give you 3 possible ways to go about that. So before we talk about how to choose the right one for your risk tolerance, let me show you what I mean by our family of volatility strategies. In the green box there, we've got our main VTS tactical volatility strategy. Now, while I don't believe it's ever a hardline trade-off, there is at the very least a relationship between risk and reward. And this main strategy is positioned in the middle of that spectrum, balancing performance and safety. The VTS conservative vol strategy moves towards the safety side by incorporating the slower moving products ZIV and VXY. And then the VTS aggressive vol strategy moves the other way, favoring absolute performance by increasing the trade frequency. So 3 different strategies targeting 3 different levels of risk tolerance. So the question now becomes how to choose the right one for you. Well, one thing I would definitely advise people not to do is to choose simply based on rate of return. As you can see, there is a noticeable difference in the annualized return of these strategies. Predictably, the conservative strategy is on the lower end and the aggressive on the high side. So it would be very easy for people to just say, well, of course I want to follow the one with the highest rate of return. But the truth is, successful investing is just as much an emotional problem as a mathematical one. And if investors want to be able to trust the process and stay the course through good times and bad, the strategies they follow have to match up to their own level of risk tolerance. If you're a conservative investor but you choose an aggressive strategy, that'll be fine when everything is cooperating. But all strategies, no matter how good they are, will go through bad years. And that's when you'd be more likely to abandon the process. And on the flip side, if you are more aggressive but you choose something quite conservative, you'll probably always be looking for something else, and that can lead to emotional decisions at the wrong time. So leaving annualized return out of it, how to choose the right one? Well, number 1, it could be as simple as just reading the name. There's other volatility strategists out there. I'm not the only one doing this. And most of them have multiple strategies on offer as well. But even with my experience in this space, sometimes I can't differentiate between them either. Pro volatility, elite volatility, genius, smart, ultra, dynamic, all cool sounding names. But what do they mean and who are they for? So I've deliberately named my strategies with generic sounding words, so there's no confusion as to where I've positioned them, and oftentimes that's enough. When I say aggressive or conservative, do you feel an association? If yes, then that's probably enough. If not, then maybe we'll move on to the second way, which is by maximum drawdown. Now, if you're not familiar with maximum drawdown, I have a full video discussing the topic, and I'll throw up a link so you can check it out later. But essentially, it's just the maximum loss from peak to trough of a portfolio's value before a new peak is achieved. So you can see here during the financial crisis, for example, the S&P 500 dropped 57% from its peak in 2007. And that was the maximum drawdown since the Great Depression. So you can use this very important statistic of maximum drawdown as your risk metric to help you decide what strategy is right for you. Ask yourself, what level of capital depreciation would start making you uncomfortable and make you start to question your investment? Now, compared to many other volatility strategies out there, even the nearly 39% drawdown of the aggressive vol strategy is fairly low in relation to the potential upside. But it is more than the just 12.7% maximum drawdown of the conservative vol strategy. And again, the main VTS tactical volatility is in the middle, with a 26.5% maximum drawdown. So you can use those as a guide to what you're comfortable risking. And this will, of course, also depend on the size of your portfolio allocation. And I don't mean dollar size, I mean percentage of your total assets. Investing is always relative to you. So if it's a relatively small allocation, some people might feel comfortable risking larger drawdowns. If it's a decent size of your assets, hopefully it goes without saying that you'd want to be a little bit more conservative. I do focus most of my efforts on mitigating risk. That's how I've been successful over the years. But risk can't be eliminated, and drawdowns are inevitable. So make sure you're honest with yourself about your maximum drawdown threshold. And the third way to decide which strategy may be right for you is by how active you want to be in your trading, trade frequency. The VTS Conservative and the VTS Tactical both target roughly 40 to 50% of the best, most clear trade signals that my set of indicators give me. Any ambiguous signals where we're very close to either taking a position or being in cash, both of those strategies will default to cash. However, the aggressive vol strategy, as the name suggests, will take a higher percentage of trades. You can see the long-term average is about 73% allocated to trades, and about 27% of the time in cash. I feel like it's not a good idea to go any higher than that because all volatility products and all volatility strategies do have risk. But for those of you out there who really do like to be in the market more often, this strategy is probably more suited to your needs. So take this with a grain of salt, of course, because I am talking about my own strategies here, but I wouldn't stress too much about which one to choose. In the end, I have confidence that any of them will provide the volatility exposure you're looking for, both through performance and diversification of your investment portfolio. But decisions need to be made, so start with the name. Do you consider yourself a conservative investor or an aggressive investor? If you feel like your risk tolerance is clearly defined, that's probably enough for you. Secondly, I've talked about this a lot in the past, but I think that maximum drawdown is one of the most overlooked performance metrics, but it can definitely help you select the right investments. Standard disclaimer, of course, past performance is not indicative of future results, but it can be a good guide. So on the spectrum of risk tolerance and in relation to your own portfolio allocation, does something in the mid-teens sound like your maximum loss threshold? Or would you perhaps risk more to have the potential for a higher rate of return? And lastly, trade frequency. If you really are the type of investor that's going to get antsy if we're in cash 50% of the time, then perhaps the aggressive vol strategy is the one that's right for you. On the other hand, if you don't mind being in cash and scrutinizing the signals in hopes of reducing drawdowns, then perhaps the other two strategies could be considered as well. And remember, nothing is written in stone. Subscribers will get access to all of the strategies, and I hope you do adopt a similar investing philosophy to my own, and that is that we're in this for the long run. What happens month to month is less important. What matters most is that we trust the long-term process, remain as safe as possible, and keep moving towards our retirement goals. So if you have any questions at all about this video or any of my other ones, feel free to reach out anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.